I feel so terrible for Junior Achievement, which is a wonderful organization that provides a ton of kids under the age of college age an opportunity to learn about personal finance. They had their charity golf tournament yesterday, which was the rescheduled date from getting rained out about 3 weeks ago, and we were absolutely rained out. But anyways, if you are, I guess, a Miami local, if you want to donate to a great cause, Junior Achievement, celebrating some personal wins today. On top of the fact that I'm going to send it, Brett, where were you this past Saturday?
I was hanging out with you for Saturday evening. Saturday afternoon, I was not with you. We were supporting our colleague who had a bunch of people over to, I guess, just get us all to chat, try to get some new clients out of the mix to help a company that was setting
What are
up.
you talking about?
Huh?
Yeah, it was in support of the person who put together the event.
And it was also to support a restaurateur who sets up and caters. I enjoyed it. We got their number. Maybe we'll use them in the future. Didn't.
I got to give a quick shout out to my wonderful children. I got two graduations this month, Brett, or basically back-to-back months. Got a senior headed off to college in the fall, and I got a little young man graduating kindergarten. That's why I was out yesterday. I had this charity thing that didn't happen, but all morning and then in the evening we were doing kindergarten celebration.
Also excited for the fact they graduated because that means traffic will be less for the next few months.
Welcome to episode 68 of Talk Your Chart with Marcos and Brett. Today is June 3rd, 2025, coming off a couple graduations, so we are feeling good. Brett, good morning, and let's get right into the first chart that I brought for us. I think we've talked about this before. I'm not sure if it was you and I or somebody else, but I just thought this was interesting. As we're going through this Build Back Better bill, and there's a lot of hopeful momentum in Congress, although it's clearly not materializing in any type of action to cut spending and maybe cut taxes and all these types of things. I was listening to a podcast and they brought up tax receipts and what tax receipts have looked like functionally from our perspective since the beginning of time, because the 1930s is quite a ways away. And it was interesting for me to see that regardless of the tax regime, and we know that at certain points in time, marginal tax rates were as high as 70%, right? We're looking at tax receipts always average around the 17.5% plus or minus 2%. And then furthermore, if you look at when you get a big drop in tax receipts, which I think makes sense, it's when GDP is bad, it's when economic growth is bad, it's when we get recessions. So I think it's perhaps not much to do about nothing relative to how much we're paying in taxes, but it's, hey, make sure that denominator, the GDP, is growing. Because the highest we ever had it was this, again, right before the tech bubble, which is just shy of 20%. So this is kind of interesting to me to see why increase the tax rates when it's really not going to have that much of an impact.
Yeah, I mean, two things. Number one, I think if Congress is trying to reduce the amount that's spent, they're doing a horrible job at that because the bills that I see seem to suggest higher spending than we've had. But anyway, that's not a point that we're going to argue about. What I think this proves to me is that companies, and what we've been telling clients, companies adapt, right? If you've got a widget being produced and you've got a high tariff being put on it, you find another country to sell it in. You find a way to be more efficient. You find parts somewhere else, and so you move stuff around so you can still make money. And as long as you're making money, that's the bottom line. And so while companies are adaptable, people are adaptable. If you can't find it in one store, you find another store. And so at the end of the day, it does make a big deal at the individual level, but the companies are going to figure out how to make things work and how to make money.
Yeah, which again, corporations are generally paying a good portion of taxes, but you can't discount a consumer. I wonder what the percentages are. We can get that for next time. 1982 to 1986, 50% marginal bracket. So you had these big discrepancies. In the 70s, it was 70%. Obviously, World War II, you're not really going to count that type of stuff. But I just thought this was interesting. Okay, next chart. I don't know if you've ever seen this. This kind of kills me because we have this whole reconciliation bill coming through that has to do with mandatory spending. And part of mandatory spending is Social Security payments. So I felt like there was an opportunity to address the £1 million gorilla in the room, which is this Social Security fund running out of money in 2032, 2033.
Somewhere
When is
around
it
there,
supposed to
yeah.
run out of money? 7 years, right? Yeah. There are all these levers you can pull. You've listed them countless times. I've listed them a couple of times. I thought this bill could be an opportunity to get ahead of that massive issue, which is going to be an issue. You can't avoid it because so many people depend on it. So we had this 7 year shot clock. And so what I wanted to talk about, which I think doesn't get any play whatsoever, was if you look under the hood of Social Security and the fund, when you look under that hood, I think I said this last episode, and I don't know if we really had the conversation. Do you know what the Social Security funds are required to be
Bonds.
invested in? Yeah, treasury bonds. Forced. Like no choice. You have to, because of a law that was put in place in the 1930s when it first came out, invest in treasury debt.
Well, wouldn't you agree that that's probably a good use of the risk, right? You're not going to invest in Bitcoin or stocks.
Whoa, what? Brett, come on, dude. Talk your book a little bit here. No, I'm obviously not going to suggest Bitcoin. And perhaps in 1930, it made sense when there were 7 stocks on the stock exchange. But in a world where index funds exist and target date funds exist, and investing has become so much more democratized since 1930, right? I don't think you can compare. How are we operating under rules when there were literally like 50 stocks and no more? So for me, if you look at this, and while all this chart is showing you is the average yield that the funds have captured from 2000 to 2019, just to kind of give you a sense. So you're probably averaging like at best 4% here, at best. And this is not compounded; these are just interest rates that the bonds are giving the fund holders. But you look at again, go balanced portfolio. Give me a 60-40 BH. That's 7-8%. That's 7-8%. How could you be against that
Because
whatsoever?
you have minus 50% declines in there and you're paying out almost all that you're putting in. So if I know I've got this liability out there,
Brett, it's the same as planning for someone's cash flow. Are you quite literally recommending 100% bond portfolios to people because they have to spend their money?
this is different because in 2030 they're not going to have any money. So I want to make sure that they have enough to pay those bills. I wouldn't want my pension. I would not want my, if it's privatized, you're talking about I have a Social Security account, then let me invest a little bit more aggressively.
No, you don't want to. You could privatize it, of course, and then it becomes like a 401k, right? Then you're kind of shifting the risk,
Yeah,
and everyone
that's
gets to
fine.
do that. But look at pensions. Pensions for private corporations. They don't just buy bonds. They're buying infrastructure investments, things that have to last forever. They're taking equity risk, but you're doing the confusing thing where you're confusing stability with safety. Stability means it doesn't move. My take on this in 1930, the US government said this is a great way for us to get funding for our spending. So we have all this excess spending. We are using our Social Security money to lend it to the government so they can spend too much.
Look, Marcos the president, I'm not sure that's going to work. So for 90 years, we've been doing it one way. You think we should do it a different way?
Absolutely. Absolutely, we should do it a different way. This doesn't make any sense. In 2025, this doesn't make any sense, dude.
Okay. 90 years of history. Got it. Change it up. Okay.
Leg into a 30% equity allocation. Give me something, dude. You're buying treasury bonds? Oh
Okay.
my
Get off
God.
your soapbox. Move
Doesn't make
on.
any sense.
We've heard your argument.
Doesn't make any sense whatsoever. Okay, you want to go? Let's go retail traders. Did you see this article? That's basically saying, forget the smart money, the dumb money's where it's at.
No.
So I feel like, and this is a conversation we've definitely had over the past 5 years, called since COVID, where I think the access to, again, not that we get 1 million listeners a month, but I think more folks are tuning in to talking heads that are taking their gaze away and their focus away from the shiny things. And we're seeing a lot more headlines like this one says retail traders go on a record dip buying spree, calming a jumpy stock market. Basically, when you get these kind of face ripping drawdowns in the market, I think we're seeing less panic amongst the retail crowd than we're used to seeing.
Well, I didn't know we became talk your headline because I don't see a chart here, but we will talk about it. We talked about, I think, last episode how there was days where institutional funds were selling, retail investors were buying. You got a lot of people who are just on this index approach. You got a lot of people who are putting money in every month, regardless of what happens. So you're seeing people make better decisions there, um, even in spite of the headlines talking about these random stocks, Palantir and others that just zoom and zig and zag, and everyone's all excited about them, and Robinhood that tells you when you make money or not. So yeah, I'd agree with you. Most people are doing the right thing. That's most. I think we're still here because not everybody does. We got a lot of calls in the last couple of months from panicked clients who were emotional about things. They're emotional not only about the tariffs, but about the president, whether you're for or against, whether what was going to happen to the state of the world and democracy and this and that. And so we're here to say, look, in mid-April we're going to buy when things are down, and in end of May when things recover, we're going to sell and rebalance. And that's what we're here for, because while people are doing it better, they still need somebody, I think, who's got an arm's length from their money, who's unemotional.
Yeah, look, I'm not going to sell against us, so that I think is wonderfully useful. On top of the fact that you get coordination amongst more things than just a portfolio, but I just love seeing this because this was on May the 19th, which was after I think almost already the 50% drawdown that came, the 15% drawdown that came. I think it was that Thursday and Friday. So 4 billion going into U.S. stock that Monday the 19th, and that's when it fell that same day around 1.1%. So I think it's fun to see headlines like this, and hopefully folks can become better investors.
Well, look,
over
but the
time.
other thing is the retail investor doesn't have anyone to answer to, right? If they screw it up, no one's going to ask questions unless maybe there's a spouse involved, or other trustees, right? Like if you're a mutual fund, if you're a hedge fund, if you're a pension fund, you've got people to answer to if you get that one wrong.
Yeah, so that's a perfect segue to this next one. Have you clicked the link that I shared with you on this one, which is the God would get fired as an active
No.
investor? This is so funny. So this is a fun one for folks to read. Alpha Architect. They put down a lot of research. They have their own bespoke ETFs and models, things like that. So they did one that basically said, if God ran a mutual fund or some type of hedge fund, would he stay in business? And basically, I said with perfect foresight, meaning they did it in 5-year intervals. You look at the head. After 5 years, you know who the winners are. So you basically come 5 years before, and God gets to buy those stocks. And when you look at the performance, he annualizes at 30%, which is pretty darn good, right? Over that same period of time, you have the S&P annualizing around 10%. Now, here's what was interesting. With this perfect foresight, you're not allowed to basically say, I'm only buying the upside and I'm getting out for the downside. It's just basically saying, today I'm going to buy the equities that are going to be the best performers 5 years from now. And you got to hold them, right? So you're going to annualize at 30% over that time period. However, the standard deviation of the God portfolio was 22% versus an S&P of 18. And the worst drawdown for the God portfolio was 75%.
Well,
85 for the
is this
S&P.
also saying that in the first couple of years of doing that, you would have had to hold the losers and hope that they'd come back? Is that what 1 and 2 is representing?
Well, no. So what they basically do is they stage it down in these charts. And in all honesty, the chart itself I thought was just funny because it has God with the lightning bolt on the last chart, which is the perfect timing on the 5-year piece, going 10 years into the future. But if you go into the article, it'll describe it more effectively. I think the whole kind of thing that this is trying to convey is even picking with perfect accuracy the best stocks ever, you still had to go through face ripping drawdowns of 75%, which is really, really hard to stomach as an investor. So this whole stock picking thing, you might be the best at it, and it's still not going to be emotionally easy because things just don't move up and to the
How many
right.
people would hold
So
on to that stock being down that?
exactly. So even if God was your portfolio manager, you'd probably still fire him because you had to deal with a 75% drawdown. So there you go. Not even God's good enough for us.
Well, yeah, I don't know how to top that. I mean, if God can't do it, you talk about just index approach. Is that where you're going?
I mean, for the majority of your stuff, that probably makes sense, right? It's always fun to pick a few stocks, try to be kingmaker. Just make sure you size it
Yeah,
appropriately.
for sure. Less than 10% is what we would say in any one individual stock.
Yeah, I think that's a reasonable place to start.
Okay. So we spent some time talking about companies adapting, consumers adapting. I know that your favorite place to shop is probably Amazon, like almost every other American in the world. And what surprised me is how big Amazon has become in selling clothing and apparel. So let me read the stat for you here. In 2013, Amazon sold $4 billion worth of clothing. This chart was taken in 2023. They're now up to $68 billion in clothing. And that's
That was 4 billion was the first
4 billion,
number.
yeah. And that's not just your socks and your underwear and your yoga pants. They're actually doing a lot more upscale sort of glamour type stuff. Um, and they now sell 13% of all apparel sold in the United States, 41% of all apparel sold online. And it's obviously more than retailers like Walmart and TJX combined. And so I think as we looked at the last few months, and I've gotten this question a lot from clients, and they said, oh my gosh, tariffs are going to mess everything up. People are not going to spend. The economy is going to go down. Why do I want to own stocks? And I think the point of this is to say that there are some things we have to keep spending money on, and maybe it's spent on different things or from different places, like we said, the adaptation. But whether it's clothing or food or a mortgage or babies being born, diapers and weddings and things like that, spending will have to keep happening. And so there is going to be a company that's going to take our money and use that to then make profits and give it out and keep that ball rolling. And that's why the stock market of all the companies makes so much money. That's why you don't have to guess who's going to win. If you just own the entire stock market as a whole, if Amazon selling does better, you'll own more Amazon. If TJ Maxx selling does better, you'll own more TJ Maxx, and on and on and on. So I was shocked by this.
Well, that's a staggering number from 4 to 60. That was pre-COVID, right? It was a pre-COVID figure, then a post-COVID
Yeah,
figure.
2013 and 2023.
Yeah, exactly. Which is
So,
awesome.
but they said that they're now getting better with using AI to help people size their stuff. They've got better charts online. You can just return stuff you don't like the sizes. So, and the young people are, obviously want to shop more online than at a mall.
Yeah, I'm the unfortunate guilty party that has gone to some website to find a thing, and then I go right to Amazon to buy it.
So, let me
Sorry.
read a quick little thing from Nick Murray, who's our god. He actually is my god. You're my second god, but Nick Murray is my first god. Um, he does writing for financial planning articles and newsletters for decades. He had a great quote that I wanted to share, about 3 or 4 sentences, maybe 4 or 5 sentences long. It says, "We are long-term owners of a diversified portfolio of superior companies that have consistently demonstrated their ability, in time, not merely to survive, but to triumph over every earthly source of crisis. A rational business enterprise that fails to earn a superior return will stop what it's doing or change what it's doing and liquidate. In a portfolio of 500 companies, one that fails will occasionally disappear and be replaced by another ones performing well. This goes on all the time and is very underappreciated in the market because the cap-weighted index, like the S&P 500, includes survivorship bias. The best thing about this is that an investor does not have to do anything. It happens all the time. It is the safest place where we can invest our long-term capital, owning the world's most successful companies, taken together."
Yep.
So
Preach.
the
Like
more
that.
things change, you don't have to guess where things are going to change. You just put your money into the market and it does what it needs to do.
Yeah, capitalism works. But again, that sounds quick and easy. Perfect. I don't need to hire anybody. Just throw the money in there. Good luck living through and behaving properly when you get the face ripping
Yeah,
drawdown.
there's also
Good luck.
thousands of index funds out there, so you got to figure out what percentage do I want to own and which ones do I want to own.
Yeah. Let me say something on that because someone told me something at breakfast the other day, and it's a gentleman that I have some pretty heated conversations with, and in a good fashion, and we've known each other for a long time. He told me that you cannot get wealthy just by owning beta. And for the folks, just kind of explain what beta is, that's basically just buying the S&P 500. That's the risk available to you. And I was like, Peter, what do you mean exactly? He's like, you can't build material wealth if all you're doing is buying the S&P 500. And I said, okay, is what you mean to say you turn 18, let's just to kind of pick a number, and at that moment you have $1,000 to your name. I think you're saying I can't take that $1,000, throw it in the S&P, and call it a day and never earn any other money outside of that. He's like, exactly. You need to take some amount of risk to be able to earn the wealth that one would want to accumulate. And I was able to kind of level with him there because it's true. You can't just have $1,000 thrown in the S&P and call it a day. You and I, for example, leverage our time through our employment to make a reasonable amount of money and then divert a portion of that into an investment like the S&P 500 so it can accumulate for us over time to help us stay wealthy over time. But we are taking a risk and being owners of this business and leveraging our time to earn a good income to then divert some
Yeah, that's
over
where most
there.
people are going to make their money in their business. Right.
Yeah,
I would argue that
exactly.
owning
So
$1,000 in the S&P is still a risk, right? I mean, the risk is,
yeah, but it's not enough of a risk. It's not enough of a risk. You know what I mean? To be able to make the wealth that you and I would even make, for example, which again is paltry in comparison to some other folks, we couldn't just do
no,
that.
but
We have to leverage
I
our
would not
time.
want him to try to decide to try something more risky just to make more money because I think over time he's going to lose money to what he could have in the S&P, right? Like I wouldn't tell him buy a leveraged 2 times S&P fund, buy a biotech fund, buy a Nasdaq fund. Like I wouldn't tell him to do that to take more risk because that's not going to get him where he needs to go either, and probably going to fall behind.
Yeah, no, I wish I bought Monster Energy 20 years ago, but I
Showing
didn't.
a video.
So there you go.
So last two charts I have here is just sort of a replay of what's happened over the last year or two, both in the S&P 500 in the first chart and the second chart with sort of the bond curve. So starting with the S&P 500, what we saw was obviously 2024 was a terrific year. 2025 started off great, and we had these big dips when the tariffs got rolled out. Thankfully, most of that's been rolled back. And I think most people have looked at what's happened in the last few months and said it's not going to be as bad as we think it's going to be. They're going to make some deals. There are going to be some concessions being made. The technology's done well. Earnings have been well. People continue to spend. Inflation comes down. Like I know we keep talking about there is risk and there are worries, but the data does not bear that out quite yet. And so we're now in a point where we have not made back all the gains from the peak, but we're only probably 4 to 5% off of that high point, coming from where we were, 17, 18% down from the peak on the low point. It just
Yeah.
goes to show you that you can't time these things. I mean, in mid-April, we basically bought stocks for our clients to rebalance, and then 6 weeks later sold them because they had made a ton of money in a short period of time. And you'd be shocked if you looked at this and said, everything has been solved. It's not. But you move on, you figure things out, and you realize, okay, it's probably not going to be as bad as what we expect.
Yeah, exactly. Everyone's talking about like this bull rally within a bear market. There are a lot of other components that go to show you there's too much breadth in the market that's positive, where this is probably not a bear market that we're inside of. And we had this little bull rally within a kind of a secular bear market. I like this chart a lot,
I
actually.
mean, 6% for the last month for May was terrific, and it's why you invest and you just continue with your strategy of saying, okay, I'm going to take the emotion out, I'm going to do what I say I'm going to do, and continue to do it. Now, bonds, on the other hand,
Yeah.
have had some benefit over the last year. If we look at where they were in April of 2024 versus April of 25 on the yield curve, the short term has come down a lot, whereas the long term side of it hasn't moved much. In fact, it's within 1 basis point of where it was a year ago on the 30-year. And so there's a lot of going on there. Number one, the Fed has cut interest rates. Number two, we've been downgraded by some rating agencies because of the debt in the company in the U.S. The Fed has now said they're probably going to pause because they're worried about potentially inflation, and they're not seeing a lot of job losses. And so, I know a lot of clients a year ago were looking at this chart and saying, I want to own the 1 month, the 3 month, the 6 months because you're getting the highest return. But now if you kept renewing that again and again, and we talked about this lots of episodes, you're now getting those 4.3 numbers instead of getting what could be much higher numbers if you wanted some long-term bonds. So if you keep doing this, you got to understand that this is based on the fact that people expect over the next couple of years rates may come down because the Fed probably wants to lower rates a little bit more. Nothing in the short term, but long term, again, you're going to make more money by being in longer term bonds.
Yeah, man, but define longer term bonds real quick.
Yeah, I mean, it's still relatively a flat yield curve, so I'm not sure I'd want to go buying 30 years, but at some point you'd expect
God, no.
the 1 month, 3 month, and 6 months to be down below 4, and the 5-year and 7-year and 10-year to be above 4, and you've got the regular yield curve again.
I know. Check this out. And again, this doesn't account for yields to some extent. I'm really not sure how it does. I'm trying to see if it's total return or not. The 20-year Treasury ETF TLT is 50% off its highs. That's just you don't want to mess with duration, right? Folks think bond safety stuff. You can't mess with those bond things because if you get trounced in a bond fund like TLT, I don't care what your coupon is, it's going to take you time to come back. And rates are not 15% anymore, so you're not going to get this race to zero from 15.
Well, hopefully you bought it
So we shall see.
because you want to hold it for 20 years, right? And you don't care about a couple
Yeah.
years in. Because that was off the highs of what, 2023 probably?
Yeah, I would have to tell you, but right before, no, off the highs before that, right?
Well, I'm saying,
Because 2022,
right, end of
lost all your-
2020, the loss of 2023, I meant, right?
Yeah, exactly. And let me, oh, gosh, this thing is off screen here. I wanted to, as you brought up bonds, I think somebody's getting thrown around there. This idea of the bond vigilantes. I wanted to use a definition that is not really technical, but just kind of let you know, because the bond market is reacting, and it's reacting to this idea that these vigilantes are betting that U.S. debt is becoming unsustainable as deficits grow too large. The reaction is to demand more interest from America to buy and hold our debt, and the cost of insuring those debts against a default is going up in turn. So that's kind of what's happening. Who these vigilantes are in practice are central bankers, insurance funds, pension funds, macro hedge funds, who are voting with trillions of dollars at a time, right? It's not RAs like us. It's not your neighbors. It's just folks throwing around different amounts of money whose time horizons are generally in almost forever. Some have perhaps shorter time horizons because they have to trade and everything like that. But these are trillions of dollars saying debt's unsustainable. You should probably get a handle on it. So I hope we can cut spending. I really hope we can grow GDP. By the way, I think we're going to get an above 3%, below 4% GDP print because of how kind of odd the other one was in Q1 because of inventories.
Yeah, I mean, look, this
And that's a
this
wrap.
does real damage to people because while the Fed can cut all day long, that's not going to affect your mortgage rate. That's not going to affect your credit card rate, your auto rate. This is going to do real damage if they keep raising the cost of the yields on bonds on the 10-year because that's what those rates are based on. So it's going to have an impact, and even more if you're right, if they can't get the spending under control and can't get their debt down.
Yeah, 100%. I said we'd be in a recession if we get to 5% of the 10-year. We're down to 4.4, thankfully. We shall see what the vigilantes tell us next.
Okay?
All
These
right.
two vigilantes got to get back to work.
Yeah, I know. Game on. Listener, thank you for being with us.
See ya.